Hello, in this video I'm going to talk about how I caught nearly 8% profit on 2 trades that I took on Australian dollar using the banana signals, the banana indicator signals. So stay tuned. So what you see is Australian dollar, and on this day, these 3 days, well, let's call it 4 days, what you see on the chart is around 7.8%. So let's call it 8% profit. And at any given point, the risk was 1%. From here to there, and from there to here. And how I caught that is based on 2 things. So what was going on in the daily chart was the most important thing for me. So we saw 3 trend candles. And before I go into this, I want to say is that the hourly time frame on the Forex market has produced, there are stats available to us that proves that if you keep your entries to trends or within clear moving markets, and you take the banana signals based on the concept that you need to understand that it has broken out of a trading range and then it's pulling back. And then you have your targets either more than 3R, or you simply trail the AIMS boxes or the 20 EMA or 10 EMA, whatever you choose. Then in the long run, you will have around 3 to 4 risk reward ratio on this method. Now, how I caught these 2 trades was mainly because of what I saw on the hourly chart, but at the same time what I saw on the daily chart. So what we see on the daily chart, those 3 trend candles, these ones, 9th, 10th, and the 11th of November. If you go to the hourly chart, they just look like this, right? So what is it? It's a downtrend. And then I apply the concept of the market cycle on this. I can apply the concept of the Elliott wave as well, but that's different. Whereas the market cycle, I can just do it on the price on its own. Elliott wave can be done as well, but market cycle is rather simpler concept. It's binary. What you want is trends. When the market is trending, you want to wait for a pullback. A pullback can be either simple or it can be this way. So this is my favorite entry, but sometimes it will kick you out. And if it kicks you out and then it goes below this point and creates a banana signal here or a cherry signal, let's call it a pin bar over here, then you want to go long. And this pattern, the pullback method, is only for trending markets. So you don't want the market to be boxed, right? And when the trend is present, then you can go long and short, and that's what this video is about. So if we look at the daily chart on the Australian dollar, on the daily chart itself, it is in a wide trading range. So for that, let's go to the weekly chart. So what do we see on the weekly chart? It's actually going sideways, because although this is the higher high and is higher than this, it's not really, moving up. And if you look at the moving averages going sideways. So then we go to the daily chart. I'm not saying we need to go to the weekly chart, but why not? Just have a look at it. What we see is that this month it went up and then it tapers. This is actually a double top. Even though this is higher than that, the distance between the 2 is very close. So that becomes your trading range, right? And that's that whole concept of the market cycle. You have a trading range or a trending market. Basically, everything starts with a trading range. Even, when suppose a market IPO'd and there's no chart available to you, there's a stock that just starts. And let me actually show you something. So this is this exciting EV company, Rivian. They came up with this beautiful truck. It's an amazing product. And Ford has invested in it as well. And it started here, right? So we have no chart. So we have to go to a lower chart to find out. Let's go to the 10-minute chart. And when it started, so over here, as soon as it started, it went to a trend, right? But you can't really call it. And then what is it here? It's a trading range. So if you were going to look at, say, Rivian on the second day, and that's the start of it, what do we have? A trading range here. So everything starts from nothing, right? And then it starts to go. So when it's consistently going up, it's a trend. But when it stops going up, then it goes to a trading range. Then it trends, then it goes to a trading range, right? That's the example from something that was just born. And that's your trading range. So the concept is, when it breaks out, you want to wait for a pullback. There you go, that's your entry. Then it goes to a trading range. Why? Because this, what is this thing? Let's delete that. High is broken. Let's go zoom in. Here the high is broken. That's your new low. Goes up, creates a new high. That's your new low because it's broken this low. This tries to break the high, but doesn't break and comes down. And then this price action here breaks this low. It is the beginning of a trading range. Now here, one can even call it a small downtrend within an uptrend, but it actually was a trading range. And then it breaks this high, breaks the previous high, pulls back. That's your entry. Goes up into a trend. Let's go back to our Australian dollar chart. So when we apply the same simple concept and we look at this chart, even though it's a trading range overall, around this time, what we are concerned with, it's a downtrend. And we see 3 trend candles. And there is going to be a pullback. And because there is quite a lot of distance on a daily chart between a pullback to the 10 EMA, it could produce very nice move for you on the hourly chart. And that was my thought process on this. But you don't just want to go there and blindly go long. What I applied was a simple concept, and you can see these lines. Let me delete that one. What I show here is basically that concept of breakout and trading range. So we know that these are 3 trend candles, and every trend candle inside has breakout and pullback inside it. See, here you have the breakout phase. Here you have a breakout phase. Why is it a breakout phase? Because there's either, a very minimal pullback. There is no really, well, this can be called a pullback, but not really, because it went up and then closed below this, and it's series of trend candles, bear trend candles. Here, series of bear trend candles. There's no pullback here because it's an inside candle. It has to break the previous high in this case to become a pullback. This becomes a pullback here because now it's broken the previous high. So here you have a breakout. So trends have 3 kind of things in a way. You either have breakouts where you have these consecutive candles, or you have tight channels, parallel ones, and they're tight. And then when this starts to lose momentum, then they kind of go like this. And this usually means that it's losing momentum, and on AO or Elliott wave, if you apply the histogram, you would see divergences happening over here. So wave 5 usually becomes like this. The structure of wave 5 is usually like that. So if you look at this chart, we have a breakout, then we have this first pullback. If I was awake, I would definitely be short on this because that's your breakout. And why is it a breakout? See, when this, let's actually go back to there. So I'm explaining this so that we can then understand why we went long on that. So this is your breakout. Why is it a breakout? Because you see high here. Let me bring my tools again. So that's your high. It's a double top. Over here, this is a failure of this low. It connects with these as well. So let's connect it, take it all the way here. Price starts to go down, reacts to these levels, obviously, right? Goes back up, hits previous levels or the 10 EMA. But what we see is an outside candle that breaks out of the trading range. That's the most important thing. That's the trigger point for me. And when a market is stuck in a trading range, I like it because I want then this breakout to happen. It happens. And by the way, when this happens, I would drop to the 5-minute chart and take a pullback over here. That's my bread and butter kind of setup. But I don't do it on Australian dollar. I only look for EU, GU, and UJ. But this is a classic setup. So if it breaks out here between these two wicks, you will have a setup on the 5-minute chart exactly like this, a pullback setup. So breaks out, then you have your first pullback, the banana signals start popping up, you go short here, and it goes. In this case, you probably didn't get much because on the next day it started going up. Now here you have a new low, but price goes up and breaks the previous high, putting the downtrend in question. And then price continued to go down but couldn't break this. So when this fails, now it's definitely confirmed that it's a trading range again. So let me delete all of this so we can start it over. So you have all of this, but it keeps changing. That's the market cycle, right? So on this time frame, you have a breakout, pullback, trend, and then you have a trading range again. So the cycle continues, and around this point, it appeared as if it's going to come round and start to go up. It could have happened, right? But you have to wait for it and see what it does. So the next candle goes all the way down, continuing the downtrend, and then it breaks out. And when it breaks out, you have another breakout phase. So you have a breakout phase, pullback, continuation that wasn't strong enough, trading range, breakout phase, pullback, another breakout, pullback, another attempt, but does not really break here, and it's losing momentum. So now what's happening is that when it starts to lose momentum, it continues to go down, but the strength of every new wave is not strong enough to create distance between the two swings. So if you look at this one, the distance between the swing high and the swing low is quite a lot. The distance between swing low and new swing high is less, which means the pullback is shallow. So the trend is still strong. And then when it goes, the distance between that swing high and the new swing low is still considerably good. And then what happens is that when it pulls back here, it's actually pulled back far more. And now it's touching the previous lows, right? Almost. So in very strong trends, price usually will not come back to previous lows. But if it comes, it introduces more selling, as in here, and it allows you to actually go short further. And in this case, it came all the way back to this level. And then when it was time to break this level and go further down, it actually failed. And as soon as it fails, you know what's happening. It's either going to go into a trading range, or it's going to taper down and create that wedge kind of trend. It's still a trend, it's a channel, but it's not as strong. So let's move this a bit. And then I saw that it turned into a channel, right? These two lines. And when you have a trend like this, goes into a channel, and when you see 3 trend candles on the daily chart, it is time for the daily chart, let's go to the daily chart, to now have a couple of candles of pullback. So let me show it on the TradingView platform so that we could go to the hourly chart, and here it is. We'll go to the daily chart, and I will use the bar replay to bring price here. So you see here, now price is away from the moving averages, and there's a higher probability that it might have a pullback, and that's what it is. So for a breakout, after a breakout, you'll have a pullback. So when that pullback happens on the daily chart, and there are 2 bull candles happening, you will get a chance for price to actually trade from these lows to those highs. And that's the little trick I use before I look at the hourly chart. I will go to the daily chart and I will ask these questions. Where did it come from? And where is it most likely to go to? So let's do bar replay again. So around here, if I look at the Australian dollar chart and I ask the question, where did it come from? Well, it's come all the way from there. And where is it going? Well, if it was going to continue further down, then most probably, and the assumption is that price goes from levels to levels, support and resistance, and particularly in Forex, it's very, very true. It's true in all the markets. Whether it's a testable idea or not, that's a different thing. But that's roughly what it does, from levels to levels. So this would be the most relevant level they would go to. But if it's stretched, and obviously there will be profit taking and stuff, where will it go? Well, from here, the first level that it will go to is the high of this candle. And if it goes past that, then the next level that you see is basically the low of these candles. So if I mark these levels, and if I mark this level here, and then I go to the hourly chart and play it, then we will see what's happening. So here we are seeing that is tapering, and around here, because this low has not broken this low, it has actually already turned into a trading range. And let's see what happens after this. Tries to break, goes further down, does not break it. Instead, it breaks what we call the the formation of this wedge. And when that happens, usually there's a new trend. So on the hourly chart, downtrend is ending and it's broken the symmetry of this downtrend. Then it breaks out and pulls back. So when this breakout happens, it would pull back to these highs again. Usually this wedge over here, it will come back and retest it and continue to go up. So here we go. What do we see here? We have an impulse move up and a pullback. And here you'll get a signal. Let's have a look at our MT4 chart. Here you see we received a signal. I usually have these price levels marked like so. And because this level was here, I can mark it there as well. I could see that it could be possibly a trading range, but this impulse move is enticing me to take the trade. Now this is early way of getting in. If you wanted to wait for a clear move, which would be best, but in my case I had done this analysis and I knew that the probability of price moving up was higher. So when I got this setup, it was actually the break of the wedge and then pull back, and we have a 2 signal, impulse move up, 4 rules apply. You go long, stop loss below, and then you let it run. Otherwise, your signal was here. Breaks out, pulls back, you first pull back and you let it run. Now, let's go back. So we take the trade over here, stop loss down there. What's your obvious target? That level or that level? Let's use that level and see how the market reacts. Starts to go up. And remember, this is that first level. It was actually the high of that same candle. Let's go to the daily chart. See the candle high or this support resistance level. Let's see where it goes. Well, we already know, but you know, that's your signal at midnight, right? Let's go back one step where we can't. See, it kind of reacted to those levels, went up, came down. So that could be your first target. So if that was your target, you're probably out. But I just allowed it to run. It went up, further up. See here, goes even above there. So why would you exit, right? Let it run. And then when it closes, well, it's not still closed. Not still closed. See, around here, as it tapers around the 10 EMA, Now it's time to get out. So where did I get out? So when I started seeing this, that it went all the way up, hit those levels, and started to come down, I took profits there, and then I trailed the box, and then I got out over there. So that was one trade, and that was 4.4R. So if we check this, because I got out there, that's 4.46. It's this over here, Australian dollar, 2 trades. The trade was taken on the 12th, around here, 14, and then exited there. So what is the story here? When it breaks out, you have a breakout and you have your first pullback. If you're not in from here, this is your entry. And then you just exit when it closes here. Or if you had this entry, then 2 or 3R target point would be the best. And then after that, because I know that the daily trend is down, and now it has hit those levels, there's a higher probability now, a chance to actually go short. And I explained this in my video on my trading plan in the blog, start of this year, or was it spring somewhere, that I want to take trades in line with the daily trend, but entries on the hourly. So what do we have here? A new high is created, and the next move does not break this high. So this low and this new high is now becoming a trading range. And as soon as that happens, then I want to see if price goes and breaks this low, and it's already hit those levels that we discussed about, and that means probably the continuation of downtrend is happening. And as it comes out, pulls back, gives me a 2 signal, there's no thinking. I mean, it literally took me seconds to pull the trigger on this, and it seconds to pull the trigger on this. And that's the beauty of H1 charts, because you have plenty of time to think, and when the signal appears, you don't think anymore because you've already done your thinking. Whereas on M1, all of this situation kind of builds up there and then. You're thinking about it, you're still thinking about whether it's a good situation or not, and the signal appears, and by the time you make your decision, probably the trade is gone. But on the hourly, if you do your practice and you apply this concept, you have enough time to think and create that hypothesis, and then when the signal appears, click the button. Actually, in fact, once the situation is clear and you're waiting for the signal, just use a script like ATM. Like, let me show you here. In this case, you have the auto button here, and then you can specify the indicator. So here you can specify the banana indicator. See, like this. Write down AIMS, the HUN 2.0 dash banana. I will actually create another indicator specifically for this and make it available to the members. And then it will be shorter name. Let's say Nana, right? That's what I want to call it. And buy index is, I will explain that. Sell index is 1 and buy index is 0, or is it the other way around? And those are coded into the indicator. So if the indicator is ready to work with ATM, then it can take trades for you automatically. So whatever settings you leave on these buttons, and then click auto, and it specifies it, and the times are correct, it would actually take trades for you. So times have to be correct. For example, here you have to enter the time when it starts. Let's suppose you want it to start there, and then you want it to actually, run. You don't want it to run for hours and hours. I mean, it's semi-automatic. So once you are in a situation and you know that if there is a signal you want to take it, then switch it on, and then it will just do it. So I have the best way of doing this is to have it on VPS, And then whenever you are like working and you see this situation, for example, right, you saw this situation, and then as it pulls back, so that's 2 hours before the signal, and suppose you were busy and you had, click the auto button, it will automatically take your trade for you. And suppose you came around here, your trade is already nice and running. Here, setting a target point was very easy. Previous lows, because I know that by the time it goes to previous lows, I would be up more than 4% and easily set a target. Then I took another add-on trade to it, but I wasn't happy about it. I didn't want to lose on it. I don't know, it was a mistake or whatever. Stop loss moved to break even, and then it stopped me out. Otherwise, that would have been a bit more profit. So that's the hourly time frame technique. It's pretty simple. You just want to wait for a breakout and then a pullback. And when you have a trend going on the daily chart, then you can trade long and short using the concept of the market cycle. So you have the trend come in, it wedges, breaks out, pulls back, boom. There's another trading range, breaks out, pull back, boom. There you go. Let's have a look at this pound dollar. Sometimes the trend is very, very strong on the daily chart. So let's suppose this is 4th of November. See, over here, it's going down, pulling back up. So you have 3 trend candles, right? Bear trend candles. Then you have this pullback. Where does the pullback come to? These levels. Market. Go to the hourly chart. Oops. See? So that's your breakout over here. Strong breakout followed by a pullback that turned into a trading range. Then it breaks out but comes back to it, and again those levels are in play, right? Look at it. Then kind of mild kind of trend comes back to it, stops there, but then overnight it starts to go really strongly down. So here you already have confirmation that now probably the trend of the overall higher time frame has found its resumption. You have your signal, you go short. That's your breakout. After the breakout overnight, it turns into a trading range, breaks out. This is where we trade the 5-minute chart, by the way. When it breaks out here, there are signals inside this. And then it goes down and all of that. This method, this is the euro dollar. So it's not really a strong signal here, but I am going long and only targeting 2R for this level, which could be a mistake. I mean, I can move this to over there, but I don't know if it will, clear that level. But ideally, I can actually go all the way there for that target and see how it goes. But if I'm not going to be here, then best to actually just take, target these level or that level over there. If we go to the daily chart, we can see that it's quite stretched. It's stretched, and yesterday is a strong pin bar. So from that point of view, there's a higher probability that the market would come to this level. So where is price going now? Now that it's broken the high of this candle, most probably coming to this low here. And after that, that high. So let's mark that as well. And now if I go to the hourly chart, I have levels in front of me. Same like what we did on Australian dollar. This is even higher probability because it's stretched further. Goes up. That's your first target. That's your second target. It can even go all the way up. What is that level? Well, that's the 10 EMA. It can come all the way there. So if you're in a trade, you can let it run. So, and these are a few concepts that we can apply, and the entry method is just that pullback. But the context is important. Your entry method has to be in the right environment. Pullback method is only for trend markets or the initial breakout of a range and first pullback and then second pullback. Over here, I went short on euro dollar, paid the rent, and you can see why I paid the rent. You see, previous levels, I disregarded them, but I thought it usually happens, it pulls back, then it continues to go down, and in many cases it works as well. But I always pay rents because of this. So best to wait for it, but it works as well, you know. In this case, it just stopped me out and then went down. So that's my take on this. And if you have any questions, do let me know. And thank you very much for watching.